somebody's got to pay the tax man. So let's talk about how this works. Think of a special needs trust like a garage. A garage just protects what's parked inside of it. And what's parked inside of a special needs trust are assets. Think like home equity values, life insurance proceeds, retirement accounts, investments, things like that. Well, when that money gets parked in the garage or gets deposited into the trust, it doesn't just sit there, it grows. And that growth is what we call income produced by dividends and interest. Someone's got to pay the tax on that growth. The way that it works is as follows. If it is a third-party special needs trust and a qualified disability trust, then any income produced, first of all, has the option to remain in the trust and continue compounding or be distributed. If it's distributed, it will be taxed at the beneficiary's tax rate. If their only income is Social Security, then it starts at 0, which means it's going to be taxed super low. If the money stays in the trust and it's a qualified disability trust, the first $5,100 is deducted. So think of it as like the standard deduction for a trust. It's not counted. But anything above that is going to be taxed at the trust tax rate. And that tax rate is very high and very fast. It's compressed. And so it's really not favorable to keep the money in there. So best practice is to essentially say whatever the trust produces in a given year is going to be distributed not to the beneficiary, because that would be bad, but to pay for things the beneficiary needs. And that's how all of this is basically maximized.